You know what people never really stop doing? That's passing away. Hi, thanks for tuning in. I'm David Marquez, and this is my analysis of Park Lawn Corporation. And based on that very grim introduction, yeah, they're a funeral services company. They own funeral homes and cemetery properties, and they have properties in Canada and the United States. Now, if you'll see here, the overall quick picture is that revenues are growing. Net loss and earnings, well, it stayed consistent until 2023, where they had to sell properties at a loss, and then their adjusted EBITDA has been growing. And they're located in the US and Canada, but they clearly have more operations in the US than in Canada. They have more employees in the US, they have more funeral homes in the US. So that's just important to note. Now, the funeral industry is very, very interesting. They have an expanding North American footprint here. They've been growing, growing, growing. They have a lot of stuff in Canada, a lot of stuff in the US, and now they're in a whole lot of states there. They have over 249 locations, 212 of which are in the United States. Now, the industry landscape here is super interesting. 80% of funeral home and cemetery locations in the US and Canada are independently owned and operated. That means it's just families, single companies, etc. And then you have a few big dogs like Service Corp International, Park Lawn Corporation, and Carriage Services, who are publicly traded funeral services company that have a bunch of locations in the hundreds, or in the case of Service Corp, thousands. And these are constantly acquiring new and smaller companies, actually. So you have a highly fragmented industry that is growing. What that means actually is that even though the death care industry is a highly fragmented market, Park Lawn is essentially acquiring a bunch. So in 2019, as you see, they added 30 funeral homes, 8 cemeteries in 2020, 19 and 13, 2021, 29 and 12, so on and so forth. So they've been acquiring funeral homes like crazy all over the US and Canada. Why is that important? Because that's their main method of growth. It's not quite organic growth, although they do have organic growth trends, but they are basically spending a lot of money. They spent 135 million, 73 million, 126 million, 94 million, 54 million, and 100 million roughly in 2024. That's a lot of money being deployed to acquire other funeral homes. How do you fund this usually if you're doing acquisitions? Well, you fund it through either debt or you fund it through other methods such as diluting or essentially issuing new shares, which dilutes current or owners. So that's something that we'll have to take care of. We'll have to take a good look at. But essentially, all of these funeral companies are acquiring other funeral services companies, especially the independent ones, at a very quick rate. So they'll all have similar trends here. Now, the balance sheet here looks to be good. They do have a lot of current assets with which to service the debt. However, the debt to EBITDA ratio, and this is a terrible graph because you have two completely different axes going on. They could just split this into two, but the debt to EBITDA ratio is basically 2.75. Um, so why does this matter? Well, the debt to EBITDA usually we want it to be as low as possible, but hopefully below 3. The reason why is in case that they go bankrupt, they have to first pay the bank, they first have to pay bondholders, other types of creditors, and then if anything is left over, that's when the shareholder gets paid. Now, we essentially want to have as low as possible, but at 3.0, so we get something in the worst case scenario. Now, organic growth projects. Now, they also have some organic growth going on. They're remodeling existing funeral homes, constructing new standalone funeral homes, etc. And as you'll see here, there's a whole lot of capital deployed in every single year. They have some maintenance capex, inventory replenishment, but they also have development and acquisitions, which is most of their growth. And then they do pay a little bit of a dividend, around 2.6%, and they do repurchase some shares, although the net is basically them issuing shares. So they do dilute you, even though they repurchase a few. So based on this, I'm going to do a quantitative model. I want to do a discounted cash flow model. Very simple. Now, note that the currency is going to be in Canadian dollars here. The reason why is because they're listed in the Toronto Stock Exchange, and I feel like that's a little more direct because you can compare it directly with a Toronto listing. Now, the assumptions I'm doing here are very simple. First of all, their revenue is going to be growing by 5% pretty consistently from now on, and then from 2024 to 2027, and then perpetually by 3%. And then I'm going to say that 10% of revenue turns into free cash flow. Those are the assumptions I'm making. That's about in line with historical numbers. Now, what's going to happen next? We are going to do that. I'm going to do that at discounted at a required rate of return of 11%. Why do I do that number? It's just my personal number. It's 1% more per year than the market in general. And if we divide these numbers by the total number of shares, we get a fair value of equity of $18.39 Canadian. Now, we did mention that they have debt from acquisitions. So the net debt is $292 and or 292 million. So just very important there to note that's in millions. And if you subtract the debt from the value, then the new fair value is actually 9 Canadian dollars and 78 cents. Okay? So let's look at where the stock of Park Lawn Corporation is now. Wow, that's very different. Okay, so many things here. First of all, if you've been a shareholder of Park Lawn Corporation, you're probably not too happy, at least not at this point, especially if you bought it in around the beginning of 2022. Kind of sucks. But we also see that it's at a historical low with a market cap of less than 600 million Canadian dollars and a dividend yield of 2.6%. Now, this number of 17.15 is below the fair value minus the debt, but or it's above the fair value minus the debt, but below the fair value pre-debt. Now, what do we do here? Well, let's understand the why. Why is there debt? What is happening here? Funeral services companies tend to acquire many companies, as we said, hence the need to draw debt, sometimes issue shares. So this is still an issue for the shareholder because depending on the interest rate of the debt and the amount of dilution, you may find yourself holding a company that you may not want to hold. Why is this? Because essentially, Park Lawn is grabbing a bunch of debt to acquire all these companies, deploy all this capital to grow. Now, let's say this allows them to grow at 5%. And let's say that the Federal Reserve makes the interest rate 7%, and the Bank of Canada does too. All of a sudden, paying for the debt is just way more expensive than the growth that those acquisitions are allowing them to do. So that becomes a problem for you. Now, this is important because you're going to have to be taking a really good look and really good care of the debt, no matter what. You're going to have to realize that their capacity to grow will also depend on the interest rate. I think the markets in general have been expecting rate cuts. However, they seem more and more unlikely as time goes by. So Park Lawn looks about fairly priced to me if we ignore the debt, with the caveat that high sustained interest rates can hurt them a lot in the long run, especially when the debt comes due and they decide to just rebalance it and it's all of a sudden at a higher interest rate because that debt from 2020 and 21 that was at 2% is now 6%, 7%. So that's something important. If you invest in this company, you're going to have to look at interest rates. You're going to have to closely monitor the debt and the dilution. What does the debt do then? That's what you have to ask yourself whenever you're faced with a company with a lot of debt. What is the debt affording them to do? Are these acquisitions or things that they're doing with the debt going to provide more growth for you at the end of the day? If so, you don't mind that a company has debt. But if not, if they're doing debt to, for example, pay dividends or pay other pieces of debt, then you shouldn't even be interested in that company, of course. So ask yourself, what does the debt do and why do they have it? Now, I hope this was helpful. I found this a very interesting company and industry. If you like this, don't forget to like, subscribe, and leave a comment down below. I love reading all your comments. Now, thank you very much and have a great rest of your day.